Good morning, good afternoon, and good evening to everyone. Welcome back to the third and final day of the IAIS Global Seminar. And we look forward to two expert panel discussions today. The first one will look at key risks in the global insurance sector, and the second panel will discuss multi-party solutions to addressing natural catastrophe protection gaps. And both topics are priority areas for the IAIS. So without further ado, I'll now hand the floor to Hendrickx, Chair of our IAIS Macroprudential Committee and Head of Prudential Policy Insurance at the National Bank of Belgium, who will chair the first panel on risks in the global insurance sector. Dieter, the floor is yours.
Thank you very much, Jonathan, and also from my side, welcome back everyone to the last day of the IAIS Global Seminar this year. As said by Jonathan, we will kick off today with a panel on key risks in the global insurance sector. The idea of the panel is to discuss the key risks and trends that are faced by the insurance sector, and we will also discuss the strategies and the responses to these key risks from both an insurance perspective, but also from a supervisory perspective. Now, I'm not alone today, of course. I'm joined by an esteemed list of panelists. We have with us today Alison Martin, CEO EMEA at Zurich Insurance Group, Simon Harris, Managing Director of Global Financial Institutions at Moody's, and Gareth Truran, Executive Director Insurance Supervision at the UK PRA. Welcome all of you. The bios of our different panelists can of course be found on the website of the Global Seminar. And what I will try to do is to build our discussion today around two main topics. For the first round, we will focus on geo-economic fragmentations, the risks related to geo-economic fragmentations, and how to address those risks. Now, before we start the discussion, I would first like to initiate a Slido poll. This will help us and allow us to get some input from our virtual audience. So my question here is quite simple. You can use the QR code to participate. And the question is, what, according to the audience, are the biggest risks insurers face today due to geo-economic fragmentation? I hope you will be able to participate. Please give us your input. And once we will get the results, I will try to pop them up and we'll try to use them as well in our panel. Now, to kick off the panel, I first turn to you, Alison, with a question on how do you see the current volatile political environment? How do you see it affect insurance business globally, and in particular, given your role at Zurich, also focusing on Europe? What, in your view, are the main risks affecting your business or that of the consumer? And which measures or strategies are you taking to manage those business risks? I know a lot of questions in one set, but I hope you can give us a little bit of perspective from your side. Thank you.
Sure. Thank you very much, Dieter. Great to be here. And yeah, it's a very broad question, and I'll try and touch on a few topics, and we can dive into something more in detail as we wish. Because for sure, we are living in very uncertain times, and the environment introduces both challenges and opportunities. And I think it's a good reminder for why actually businesses need to be resilient to deal with multiple challenges. So if I start with maybe a quick look at the trading environment we're in. So unfortunately, I don't have a crystal ball, so I don't know what the outcome is going to be of the US and the rest of the world tariff discussions. I hope sanity will prevail, but we do have to be prepared for adverse outcomes, albeit, and I think this is important, not at the risk of distraction of the businesses in endless scenario planning, because I see that as a real risk for business. But the tariffs, I guess, how we see things right now. I mean, clearly the existing and the threatened tariffs are increasing costs around global supply chains across multiple areas of business for European exporters, for customers. I mean, that's no surprise. Rising input costs are being passed on to consumers. It's squeezing margins and, of course, dampening demand. Now, the good news, and as the CEO of a business, I always try and look for good news as well. I mean, this is a playbook that we have seen before. So we know premiums will have to increase where we see claims cost is going to rise. Life insurers will need to be prepared in the face of volatile markets where we know that we can see increased lapses or new business challenge. Heightened litigation and economic uncertainty we know puts pressure on liability, particularly areas like D&O coverage, to name just a few. I think in this turmoil, I think it is important to say that there are some positives that we see. So the resetting of the geopolitical norms does mean we see a big opportunity in the repositioning of European competitiveness, rearmament, which is probably not something I ever imagined saying on a panel a few years ago. I mean, that's a big opportunity for industry and insurance to support the spend of euro 1 trillion. I mean, surge in infrastructure spend, renewables, communications. I think the interesting thing is it's going to not just be defense, it's digitization, it's large scale construction, property, all the things that insurers are there to support customers to do. Not without risk, of course, because we will need specialized insurance products to deal with newer technologies. So we do need to also improve our underwriting. Credit risks will probably get better on the margin because we see some stronger sector-specific dynamics, which will probably compensate for poorer economic outlooks. And cybersecurity, where you see increasing defense spend in IT security, military intelligence technologies, that tends to improve resilience. And cybersecurity has obviously been a key focus area for insurers. And I would be wrong not to flag that I think the Savings and Investment Union of the European Union, that I think that as a notion and the ability for citizens of Europe to help co-invest in that new European future, I think that's a really exciting opportunity. But back to risk, it would be surprising if on a panel with insurers, I don't mention climate risk as one of our biggest focus areas. And I think this has become politically even more challenging than it used to be. I mean, the numbers speak for themselves. We know extreme weather events are increasing in their impact. Last year to 370 billion, about 40% of it's insured. I mean, you can argue how much of the increase is due to economic factors and more residential and commercial property being put in harm's way. But ultimately, we know this is an exacerbation of an issue that we do see increasing severity of events. So we have to build resilience. And that's a huge focus for us at Zurich on how do we support more resilient societies, more resilient corporations. Now, obviously, it's not just a physical risk, though, climate. Insurers were in the forefront of litigation when it related to the harms of asbestos, tobacco. So we know litigation risk is a very real and present threat. So climate risk for us is a hot topic, as is supporting customers with transition. New technologies mean new types of risk. So we need to keep pace with innovation as our customers do. And then, I mean, the politicization of this issue, I mean, it's difficult enough to manage climate risk as it is, but the lack of common agreement on the roles and expectations of different actors is making this really challenging. So some believe the market should be left alone to sort it out themselves. Some believe the insurance industry should take the role of the government and decide what is right and what is wrong. And then some believe governments need to step up more and provide clearer policy. None of this is helping manage the risk. I think maybe a very quick word on a couple of other risks, but I promise I'll be quick. Conflict, again, I didn't expect to be on a panel talking about conflict, but clearly these impact insurance business, particularly when it comes to supply chains, so marine insurance. So we also see cyber insurance increasing from a threat perspective. Digital infrastructure vulnerability, this is probably a newer one for us. I mean, European industry and insurers, we rely heavily on enterprise software, cloud services, AI, data flows managed by non-EU providers, particularly US ones. Only 2% of the cloud market is served by EU-based firms, and geopolitical tensions are only increasing the risks to companies, whether we're talking about data breaches, service interruptions, rising technology costs, or perhaps at the more extreme end, politically motivated restrictions on digital services. So I think these geopolitical tensions are providing risks that we probably never anticipated that we were going to need to manage. And then lastly, maybe a super quick word on cyber. I mean, cyber attacks we know are more frequent and severe and increasingly being used as a tool of statecraft as we see geopolitical tensions rise. I mean, last year, the cost of global cybercrime was more than $9 trillion. I mean, this is only going to keep increasing. So again, resilience is key. Public sector insurers need to work together to improve this. So I'm conscious of time, so maybe I better leave it there for now and we see where we go.
Thank you very much, Alison. I think you gave a very comprehensive overview of how these geopolitical tensions, this economic fragmentation, how many underlying risks are impacted by that. You've mentioned the trading environment, you've mentioned climate, cyber. It's all being impacted by this environment, and I think it points to very much to what you say, the importance of resilience, the importance of scenario planning I heard you mentioning. I think we'll maybe come back to that as well. And it's good that you've also mentioned the opportunities. So we don't want to be too gloomy. It isn't a difficult and a challenging environment, but it will also present some opportunities, as you've highlighted. Now, I wonder, in the meanwhile, before I turn to Simon, whether we can also have a view of the participants, whether we have some results already from the Slido poll on what they view as the most prominent risks in this respect. Difficult for me to be able to read that. Apologies. I'm not sure if the other panelists are able to view the results, so it's not only me. I see there is a risk that is clearly trending towards being the most prominent one, but unfortunately I'm unable to read it. Maybe we can come back to it later. In any case, I'd like to come to Simon now. Simon, from a thanks. So we have some input in the chat highlighting investment flexibility, the difficulties maybe in certain choices there, and also cyber risk, as you mentioned as well, Alison, is apparently also shared by the audience. Now, Simon, let me turn to you. I'm very interested to know in what is the view of a rating agency here in terms of which do you see the main risks being faced by the insurance sector, and how do you see these risks evolving? Please, Simon.
Sure. Thank you, Dieter. And again, thanks to IAIS for the chance to be on this panel today. So, I mean, I will touch on quite a lot of things that Alison has already mentioned, but I guess coming into this first, I think it's important to point out from a rating agency perspective, what's the current position we have in terms of rating outlooks. And actually, from a European perspective, on both life insurance and P&C insurance, we actually have stable outlooks. We changed our outlook on P&C from negative to stable earlier this year. So that's a good position to start coming into when thinking about these risks. And in fact, for the reinsurance sector, we have a positive outlook. I've been at Moody's well over 20 years, and it's the first time we've ever had a positive outlook on reinsurance. And I think those of you in reinsurance will understand why, but it reflects the pricing environment, the drive, and the need for reinsurance that we think is a permanent feature. So again, we're coming into this environment that, yes, there are risks we're going to talk about, but we come in with a situation where life insurers and P&C insurers and reinsurers are all in a pretty good position from our perspective. And that's built on a couple of things. I think profitability has generally been pretty strong, supported by higher interest rates. Capitalization levels are generally strong, or either on a regulatory or on an economic basis. And asset quality, we're going to talk about changes in assets, but at least right now, asset quality is generally seen still as a strength of the industry. But the things that we worry about from a rating agency perspective, I'd really highlight a couple of things. Again, Alison mentioned some of these, but the macro environment, the geopolitical environment, the tariff uncertainty, it does put pressure on, particularly on asset values, on asset volatility, and as you know, insurers are big investors in assets, and so therefore that creates some issues that the insurers need to be aware of and manage appropriately. On the asset side, and I think maybe we'll come back to this later on, but we are seeing an increase in use of alternative assets, not everywhere, and maybe not to levels which are immediately problematic, but there is a change in approach to how insurers think about alternative assets. So that's something we're keeping an eye on. Alison mentioned climate change. I think our view on climate change is this is something which the industry can manage, but it needs to be managed, right? I mean, so the industry has insurers and reinsurers have regular repricing, very good risk management tools, but we all know that the climate is changing, and it needs to be managed carefully by the industry. Two other things I'd mention. which I don't think we've touched on yet. One is around reinsurance strategy, and in particular offshoring of use of offshore reinsurance, which isn't automatically a bad thing, but it needs to be something that we make sure we understand from a rating agency perspective. So that's one area I'd flag. The other area I'd flag, maybe a particular interest for this audience, is around interaction with regulators, and particularly in Europe, the issue of insurance being value for money, and that's a very fair point, very fair question, but it is something the industry has to manage. How can they manage providing the right sort of customers, the right sort of products to the right customers with the right value around that? So those are some of the risks that I would highlight. One thing I'd add as well, I mean, I think as you mentioned, Dieter, in terms of the responses, the participants about what were the highest risks, we had investment risk, market volatility, cyber, and complexity being the top three. We actually also in Moody's completed a CFO survey of a high number of insurers and reinsurers, European groups, in the last couple of months. And the three things they highlighted were firstly, low economic growth, macro environment. Secondly, geopolitics. And thirdly, pricing and competition issues. So there's some overlap there. I think that the first one seems to be consistent around low economic growth. It's consistent with the investment environment and market volatility. Certainly, there seems to be consensus there based on what we saw from the survey we took of our insurers.
Thank you very much, Simon. I think also it seems to point at least that we are looking at the same type of risks everywhere around the world and from different perspectives. So to some extent, it seems that we have similar views. You mentioned asset quality. I'm sure we'll come back to that also in the second round of today's discussion. And I've also highlighted indeed that what we noticed at the IAIS when we performed our analysis, like strong profitability, good ways to generate capital, strong capital positions. And this is also something we've noticed through our global monitoring exercise. So it seems that it points also in that sense to in the same direction. Now, let me turn to Gareth to get a supervisory view here. Gareth, out of the risk just mentioned, what are, in your view, the main risks that PRA is focused on? And let me immediately combine it also with a question on how is the PRA supporting measures to mitigate maybe some of these risks? Have you had the need to issue any supervisory measures, or are you planning to do so? So please, Gareth.
Okay, thank you, Dieter, and it's a pleasure to be here. So very welcome to have this opportunity to discuss these issues. So I think, I mean, perhaps unsurprisingly, I think I share many of the perspectives that Alison and Simon have talked about. I think the industry, certainly in the UK, does start from a resilient starting point. But if we think about some of the issues we've discussed, those map pretty well to our supervisory priorities. We put an annual letter out to our industry highlighting the key things that we are focusing on in our supervision. And on the life side, I would highlight a couple of things there. So we have a big shift taking place in the UK at the moment in pension liabilities, moving from the corporate pension sector into the life insurance sector. We may come back to that later on, but that's obviously bringing insurers much more to the forefront in looking at the investment opportunities that they can take advantage of to help fund economic growth, but also to enable those transfers. And we have asset-intensive reinsurance as another feature here, which again I'm sure we'll come back to. On the general insurance side, as well as the issues that have been mentioned, I mean, we're also focusing on the shift that we're seeing in the market cycle. So as Simon mentioned, we're on from a period of very sort of strong profitability, but certainly some signs that is shifting. So making sure that insurers focus on that is obviously an area of importance. And more broadly across the sectors, looking at areas like operational resilience, cyber resilience, and some of the climate risk areas. So I think those broad areas map pretty closely to many of what we've discussed. I was going to say a little bit more on a couple of points. One is the the fragmentation point. And I think that's an area that the IAIS is clearly focused on, and we are too at the bank. And there's many indicators. I think the IMF runs a number of measures on this. And I think the one measure of sort of global fragmentation is at the highest it's seen for several decades. So I think we're definitely in a period where that is to the forefront for the reasons we all know about. But I think some of those geopolitical tensions, reduction in trade, can sort of interact and reinforce each other as we think about the risks to the global economy and the financial system, and for insurers, the risk that they face in their credit exposures, and also from a underwriting perspective, changing the nature of some of the risks and claims costs there as inflation perhaps is a bit more prevalent. But more importantly, well, as importantly for us as the regulator, we are very focused on the risk of fragmentation in terms of global policy cooperation. The UK is a very significant international financial centre, and the role of the international standard setting bodies, the cooperation we have with other regulators, including obviously through bodies like the IAIS, is an important part of our international framework. We have a large role as a home supervisor, but also as a host supervisor for firms from around the world, and we need to ensure that international cooperation is at a high level to make sure that we can operate that system effectively. So we're very keen to continue to play a strong role in helping to both set and maintain international standards there, partly for those reasons, but also because when we look across the risks that we've just talked about, that many of those are global. Climate, the market changes, the international trade issues are not ones that we can solve individually as nation states. So we're a very strong supporter of that. Briefly on the investment risk side, and clearly we've seen volatility in recent months. Actually in the UK, our life insurance sector, it starts from a strong position, but is also less exposed to some of the short-term market volatility. We haven't seen a big impact there, but the key risk for us really is to what extent that moves forward into broader economic challenges and the outlook for the credit portfolios that our insurers run. So what you asked what we're doing about that, Dieter. I think from a fragmentation perspective, as I say, we remain strong advocates for and contributing to those international bodies, both on the banking and insurance side. Andrew Bailey's just taken up the role of chair of the FSB, so that remains a priority for us. I think on the domestic side, with the focus I mentioned on investments, we're doing a number of things. I'm sure we'll come on to the risks that we're looking at, but I think we're also trying to make sure we play an important role in helping facilitate the insurance sector invest in the real economy and support innovation and growth, given the economic challenges we play. So where that interacts with regulatory frameworks and at our role, we're trying to make sure that we do what we can to support insurers investing in appropriate assets and make sure that we can facilitate that and not be a barrier to that. And we're very keen to do that. The final thing I'll mention, perhaps in terms of some of the things we're doing to test that, I think you mentioned earlier the importance of scenario planning and thinking through different versions of the future. So we do place quite a strong emphasis in our supervision on stress testing, both in terms of what we expect firms to do to test different scenarios, but also in our own work. We run a biannual stress test. We're doing that slightly differently this year for the life insurance sector, where we will assess the impact of insurer solvency from different financial market stresses and other scenarios. But we are also moving this year for the first time to a framework where we will publish the results of that, both for the sector, but also at an individual firm level. And we see the role that market discipline and transparency can play there as being important alongside our own supervisory effort. So I'll leave it there, but happy to come back to some of those things.
Thank you very much, Gareth. I think that was a very comprehensive overview. And I can only agree with you on the point on the fact that the many of the risks we discussed today, indeed, they do not stop at national borders. So they do require also from the supervisory community an important effort to continue to discuss them at the global level to try to align our approaches. And that points to the importance, I think, also, if I can advertise once more, the global monitoring exercise, for instance, at the level of IAIS, where we do try to, at the global level, pick up the challenges that are presented to us by this environment. Now, apologize, but in the interest of time, I already have to move to the second round of this panel. But I think I had a great introduction because both Simon and Gareth mentioned some of the elements that we will try to discuss here now. We've mentioned how alternative assets, at least for some insurers, continue to play an ever more important role. I've also heard mentioning asset-intensive reinsurance. And that's actually the two things we would like to cover in this second round, where we'll take a look at these shifts, these structural shifts we see in the life insurance sector that are characterized by an increased investments in alternative assets and increased use in asset-intensive reinsurers. Now, again, as I did for the first round of discussions, I'd like to get some input again from the audience via a Slido poll. And again here also, I hope the question is easy enough to answer. What, in your view, are the main risks associated with investments into alternative assets? We've highlighted here a few elements such as valuation uncertainty, illiquidity, complexity, etc. So we appreciate the view of the audience, and I will try to pop up the results as soon as it is possible. Now, for my first question in this round, I turn again to you, Simon. Be very interested to have a rating agency's view here on the increase of allocation of life insurers towards these alternative assets. I think you've mentioned that there are some concentrations and the growing use of asset-intensive reinsurance. So what is your perspective on this?
Sure. Thanks, Dieter. Well, yeah, as I mentioned, it has been something we've spent quite a lot of time thinking about, and it's a bit of a concern for us. And to properly assess the level of that concern, we've done a couple of surveys. We receive a lot of information in financial statements, obviously, but a lot of the information around asset quality and nature of assets we conduct via surveys. So we've surveyed our European population of insurers and our US population of insurers, and in fact globally as well, and published a couple of reports in the last few months. Now, what we concluded from that information was, firstly, for the European side, there has been, and I should say, by the way, it really depends what you mean in terms of definition of alternative assets. When we talk about private alternative assets, we're including things like private placements, mortgages, private debt, private equity. So it really depends on definition, but we're using the same definition globally to approach this. And what we found was that from that perspective, alternative assets was about 13% of European insurers' investments at the end of 2024. That number was a bit higher in the UK than it was in the European Union states. And I think that's probably driven more by the fact that many UK insurers have a higher proportion of annuities. And so alternative assets are a better match for those kind of liabilities. So 13% across the board in Europe is a decent number. We expect higher in the UK. If you do the same survey which we did in the US, you're looking at more like a third. So quite a significantly higher use of alternative assets. And, to us, that's not really a big surprise because, as many of you know, there are much more connections between many US life insurers and private companies, private asset generators. And some of them are owned by these companies. Some of them have affiliations to them. But there's a much stronger connection that's been building for a much longer period of time. So that's the kind of the picture as we see it. And so in both cases, those numbers have gone up recently. And again, the number is higher in the US than it is in the EU. We think that from a European insurance perspective, we actually think this is actually a credit positive, which may surprise some people. And a couple of reasons for that. Firstly, what we've seen is that what's happening is that many European insurers are reallocating from public exposures to private exposures, but they're generally the same kind of thing. They're just moving from public to private. So it's they have similar sort of qualities, but it's just the nature of the assets is private versus public. And the benefits that we see insurers getting from that, you do get a yield pickup. There is some diversification benefit typically because you're investing in slightly different asset classes. There's a better ALM matching potentially as well. So those positives outweigh the negatives, which from our perspective are around illiquidity and opacity. And we'll see what your survey says, but those are really the issues we see about private assets are transparency and lack of liquidity. Those are the issues. But those things can be manageable. And also, the thing I would say as well is that private or alternative assets, private assets, there's nothing inherently wrong with these things. There's nothing inherently particularly problematic. And in fact, many insurers have invested in these types of assets for many years, for decades, in fact. I think what really counts for us is, do the insurers have the skills and the ability to know what they're investing in and to manage those assets appropriately and make sure that they understand the risk they're taking on. So that's it on the alternative asset side. Now switching to reinsurance, and again, this is quite it's region specific. I mean, as you probably all know, this is much more of an issue for US life insurers in particular, where there's been a huge increase in the use of offshore reinsurance to places like Bermuda, not only Bermuda, but other places as well. And again, this is not necessarily inherently a bad thing to do, or a credit negative thing to do, if you like, but it may introduce things like counterparty risk is one particular issue we're concerned about. What's the counterparty credit risk that the ceding insurer is taking on? And the second thing we have concern about will be, what's the regulatory environment like compared to the home environment? Because there are, regulation, as you all on this audience will know, is not the same around the world. So we spend quite a lot of time looking at counterparty exposure, looking at the quality of the regulatory environment that the risks are moving to. And what we're worried about there is there a risk of recapture? Does something happen either at the cedant or somewhere else that the ceding company has to recapture the cessions they made, and can that be slowed down somehow, or can that lead to sort of issues that may be problematic for the ceding company? But this is a massive growth area. I mean, again, just looking at the US, there's at the end of last year, $1.1 trillion has been ceded offshore of liabilities, which is twice the industry's capital or surplus level. So it's meaningful. It's a risk that has increased in recent years. Again, we're not saying that it is automatically a bad thing, but we need to monitor where the risks are going, and what counterparty risks the ceding companies are taking. So I'll leave it there on those 2 points. Cover quite a lot of ground, Dieter.
Thank you very much, Simon. Again, very, very comprehensive overview of both trends. And I think many of the elements that you mentioned in terms of asset-intensive reinsurance on recapture risk, counterparty risk, etc., we may hear later on from Gareth as well, maybe how that keeps us as supervisors busy as well. I'd like to highlight as well one important element, because indeed here, and also the poll illustrates it, we focus very much on the risk and challenges, but I think you've pointed out correctly that there are indeed also positives here. Yield pickup, the opportunity to differentiate a little bit more in the investment portfolio. And often we do notice that these alternative investments indeed are quite equipped to match the long-dated liabilities of many insurance. So you've very much rightfully highlighted some element where we as supervisors are also very much focused on how to ensure ourselves also that insurers very active in these fields can give us the necessary comfort that the skills and expertise are present to be able to cope with the extra challenges and complexity sometimes of these trends. Now, I'm very curious to see how the audience feels about this. So let's see if we can have some results. This is very interesting. So we have around 30%, a bit more, pointing us to valuation uncertainty and transparency, which was also already mentioned, and a little bit less, 20% on complexity, and then illiquidity and hidden leverage is viewed a little bit less as a risk or challenge. So I think, that points us to questions on valuation, uncertainty and transparency, often undoubtedly related, those two. So Gareth, I'll take this opportunity also to turn to you again. And I'm very curious, because you've mentioned it already as one of those main items that UKPRA is looking at. So what are your main concerns in terms of these two trends? Do you see any concerns in terms of financial stability? Are there any PRA initiatives here to try to mitigate these risks? Did you issue any specific regulatory initiatives or guidelines to help you monitor? I know as supervisor myself that these are not the easiest risks to monitor. In particular, also with regard to asset-intensive reinsurance, as Simon explained, the UK market, you do have some exposures there. So please, Gareth.
Yes, thanks, Dieter. Well, let me start with the asset-intensive reinsurance, and then I can talk more broadly on the alternative assets. So, as you say, we have asset-intensive reinsurance or funded reinsurance in the UK market, alongside the trend I mentioned earlier for the growth in pension risk transfer, and we've really seen that pick up as interest rates have changed, the funding position of those schemes have changed, you can understand the role that asset-intensive insurance can play in helping insurers source perhaps some different assets that they could maybe struggle to originate themselves, and it also obviously helps from a capital strain perspective on new business. But as you mentioned, we have been monitoring it quite carefully because, notwithstanding some of the benefits there, it is an area that's growing fast, and as Simon said, there are some risks that we need to manage, and we've been sort of welcoming and very engaged with the IAIS's work on this too, through the structural shifts paper. I think our perspective on this is that these transactions can often involve counterparties where the business models are quite heavily focused on private asset origination rather than traditional reinsurers, and that does bring the potential for higher concentrations to illiquid assets, and perhaps more correlation in the risk of default. So we're keen to understand those trends, but also the growing interconnections between these transactions in particular and the broader private market and private credit sector, because the nature of these risks is quite hard for any single regulator or firm to really analyse. It does require us to think across the system as a whole. I mean, in the UK, we've seen, well, from a supervision perspective, we've done some supervisory work on the controls that UK insurers have over these transactions, the way they're managing those, and we've published some policy expectations for insurers who are active in this market, covering the sort of risk management expectations we would have, the solvency modelling, how they're structured, and as Simon mentioned, how insurers assess the risk of recapture of collateral, particularly where that wouldn't fit their own portfolio requirements, or and so on. So that has been a focus for us. We've seen some signs of improvement in some areas as firms have responded to that, but also mindful that there are commercial pressures pointing the other way. So we have noticed some deterioration, for example, in the type of collateral standards that often accompany these transactions. So we've been looking hard at that. I think at a system-wide level, I think it's been mentioned, it's really the concentration risk that we worry about across the system, which is hard for any individual firm to assess. And so we are looking at how that might play through in stressed circumstances where recapture events might happen, where in response to underlying stress in a particular sector where multiple transactions could be affected, or there could be correlations about the type of counterparties that would be under stress at the same time. So we do expect insurers to think carefully about that. But also, as I mentioned, we're doing our own stress testing work this year, and alongside the general market scenarios, we've also asked firms to model the impact of a recapture scenario for their largest asset-intensive reinsurance counterparty, to understand the impact that would have if they bring that back onto balance sheet. Just briefly on the broader private markets trends, I think that's been a strong focus for us too. As you mentioned, there are very many good reasons why private assets can play a very sensible role for insurers, particularly where they are looking to back long-term liabilities. But again, there are risks. So the data I think shows that quite a large proportion of private equity-backed corporates often have higher levels of debt financed through perhaps more risky structures like leverage loans, and so they're maybe more exposed to some of the economic trends we were talking about earlier, like higher interest rates or deterioration in sentiment. So we have been monitoring that closely at a system level. Our financial policy committee has been looking at that. I think our view at the moment is that the private finance sector is resilient, but particularly as we've moved from this low interest rate environment into a more challenging position with the challenges we talked about to global growth and credit, that those issues around higher leverage, some of the opacity about valuations, and the interconnectedness between different parts of the financial system, including through ownership, as Simon mentioned, or debt and equity financing, leverage, liquidity, and so on, really could come more to the fore. And those interconnections are important for us to think through. So at the macro level, the bank's also thinking about how we improve our analytical capability on things like that. So both to understand the behavior of different parts of the financial system under stress and how those dynamics might play through in practice, but also to address some of the data gaps that make it harder for us to really follow those through across different parts of the sector, beyond insurance into the broader financial credit market. So I'll pause there, but yeah, definitely a topic that we're very focused on. Thank you.
Thank you very much, Gareth. And I must admit, I'm intrigued myself in some of the work that PRA is doing there. Also, you mentioned, for instance, the stress test and on the recapture risk, etc. I think it's very much trend setting. And you've highlighted very much also the challenge that we are struggling with at, I think, also at global level, how to understand and how to monitor best what is happening at a global level. Also, the interrelation with other parts of the financial sector. I think we're still all learning in that respect, trying to understand which role insurers can play here. And you mentioned the data gaps. That is a challenge indeed. That is, albeit that many of us already collect a lot of data, we still notice that there are some areas where we do perceive those data gaps. Thank you very much. Now, I'm going to use this opportunity to turn also very quickly back to you, Simon, because Gareth mentioned it as well, and it's one of our points of focus at the IAIS on private credit, private assets, and we know also ratings play an important role here for this asset class. So how do you cope with this inherent opacity and complexity of these markets, also when assigning ratings, for instance? And what are your views on public versus sometimes private ratings for private credit and other alternative assets? Are there any risks we should be aware of?
Sure. Thanks, Dieter. Well, yeah, I mean, you're right. Opacity and complexity are just inherent to private markets. That's kind of it's in the definition, right? So they are inherently more opaque and more complex than public markets, and that does bring challenges. The one thing I would say on complexity, yes, you can have private structures which are very complex, but you can also have public structures which are very complex. So I wouldn't necessarily say that private markets are, by definition, more complex than public ones. That isn't always the case. They can be equally complex. There's some which are more complex, but it's not. It really is case by case. Opacity, though, is an issue, and data. It's not lack of data. The data is there. I mean, private lenders and private equity investors, they get huge amounts of data because of the position that they have and the closeness they have to the companies they're investing in. But does that information flow around to the market and to the industry? Well, no, it doesn't. There's a data flow issue there, and again, that's part of the definition of private markets. But I will tell you that what we do in the rating agency when we're assigning ratings to private, whether they're public or private ratings, is we receive a lot of information from the sponsors about the general partners, the limited partners, the different companies that are involved in various transactions. So we spend a lot of time, possibly even more time, because of the number of parties involved in some cases, getting information about the companies involved and their financial position. When we assign private ratings, private credit ratings, so there's a lot of information that we get as a rating agency, and also when you think about some of the structures that we rate all sorts of different structures in private credit space. The most public ones are business development companies, or BDCs, in the US, which, as you know, are publicly traded entities. There's a very clear requirements they have around things like transparency and regulation and capital requirements and liquidity requirements. So those entities in themselves are already very public, and there's a lot in the marketplace about them. We get more information as well behind the scenes when we rate those companies. So that's at one end of the scale, if you like. And then maybe the other end of the scale, you have structures like subscription lines or net asset value facilities, where typically there is not really much information at all in the public domain. And then again, that's where we spend a lot of time working with the arrangers to get the information we need to rate those transactions as accurately as we can. And the issue about public versus private ratings in terms of how we approach that, I would say our rating approach is indifferent to whether the ultimate ratings are public or private. We apply the same rating approach with the same level of integrity, because the rating has to be, whether it's public or private, has to be equally correct, basically. So our rating approach is the same. It's really whether the rating is public or private is the choice of the customer, frankly. And sometimes ratings are private, sometimes the ratings are public, and there's all sorts of different drivers for that decision. But it's the decision that the customer of the rating would make. And then just to close out on the risks around private credit, and we've touched on them already, but it is around opacity, and it can be complexity, because it just depends, is the amount of information in the market or to investors made available to investors sufficient for them to really understand the risk they're taking on. And again, it's not to say that private is automatically more complex than public, but the information flow may not be as strong, which can make it difficult to understand what's going on. And then liquidity, what assumptions do people make about liquidity of private assets, which obviously they are inherently less liquid. And I think it's important there isn't a disconnect between what investors and others assume about liquidity versus what the practicality of liquidity is, particularly in a stress environment, which you may argue has not been fully tested in this version of private credit.
Thank you very much, Simon, to give us some insight into that, how that rating process works, both for public and private, and as you say, how it is maybe indifferent or approached in similar ways, whether it is public or private. Alison, allow me to turn to you again. We've heard from a supervisor, we've heard from a rating agency, we've heard as well how some of these trends are concentrated in certain parts of the world, even in certain insurers. So I'm just curious to know how should I understand Zurich's engagement, for instance, in asset-intensive reinsurance, if any, and how do you see that fitting or fitting not maybe in your strategy?
So we operate a pretty conservative business model, including when it comes to life insurance. So if you wanted someone to defend asset-backed reinsurance, that's probably not Zurich. I thought Simon's statistics were quite interesting. We have even less private assets on our balance sheet than the average of Europeans. Now, whether that's something to do with the solvency regime we're under and the prudent person principles and our ALM approach, I can't say. But in an effort to be helpful to the panel, I think there is a place for high yield, and I think both Gareth and Simon have talked about that. I think particularly when we're talking about interest rates lower for longer and the environment that we've been in, whether we're talking about the need to meet customer demand. And I think if we look at our unit-linked products, for instance, we operate a capital light savings and protection philosophy. We've done that for more than a decade. But within our unit-linked product offers, if it's right for a customer, if they want to have an allocation to a small allocation to private assets, then that may work for them. That may be appropriate if they want to get the yield. Now, that does depend on risk appetite, diversification, etc. It needs to be part of a broader ALM. They would tend to need to be wealthier customers, let's face it. But I think there is a role to play. And I have to kind of do a parenthesis. I did ask ChatGPT-4 as well what it thought about asset-intensive reinsurance, and it's come up with pretty much exactly the same comment. But the one thing that I think it's raised, because we have looked at it previously, and one of the things that it's raised as a concern, which hasn't come up yet, is what level of confidence can we have in the ability of the reinsurer to have the skills and capabilities, and perhaps Gareth touched on this a bit, to be able to actually match quite complex guarantees that tend to be in some of these portfolios. So how confident can you be in that? Now, because they're clearly that these models work very effectively to put yield into well-matched portfolios, but the liabilities can be incredibly complex. So I think that certainly when we've considered these types of models before, that has been a concern of ours, and of ChatGPT as well.
Thank you very much, Alison. I think you point to a very important element on the matching, which I mentioned at the start as well. And maybe ChatGPT is also something we could consider at the IAIS. So, you know, we have been thinking a lot, and it was mentioned, I think, by Simon, how to define alternative assets. Is there such a thing as a good definition? We've tried to work with principles. Maybe it's a good idea to ask ChatGPT once what he or she, I don't know how to pronounce that, feels about that. Now, I see we have around 5 minutes left for our panel. So I would like to give maybe the opportunity to the audience also to participate. I'm very curious to see if there is a question from the audience for the panelists, whether they would like to hear one or the other perspective. I understood that you may be able to participate either through asking your question through the chat function or the Q&A function, or ask for the floor. So I'm trying to check now whether there are any questions from the audience, and hopefully we'll be able to answer those. I'm depending now a little bit on the input that I get. Do we have any questions?
I could see there's a question in the chat.
Yeah, now I see it as well. Sorry.
Yeah.
What specific concerns do you have regarding the regulatory framework in Bermuda regarding your comments on counterparty credit risk?
Yeah, I think that's probably one I can take.
Please, Simon.
Yeah, so I mean, look, I would say the way I think about it is that counterparty credit risk is independent from the regulatory environment. I'd separate the two things out. Counterparty credit risk can be an issue whether you're in a very strong regulatory environment or in a very weak regulatory environment, right? It depends who you're dealing with. So that's the first issue. And secondly, around Bermuda specifically, what I said about offshoring of reinsurance and the increasing, particularly coming out of the US and going to Bermuda, we think the Bermuda regulatory environment is actually a strong one. You know, it's EU equivalent, Solvency II equivalent. And there's been really some significant improvements in enhancements to the Bermuda regulatory regime in the last couple of years. So I certainly would not want it to be perceived that I was saying the regulatory environment in Bermuda is not strong. That's not the case. I guess the point is, though, that if an offshore regulatory environment is different to the home one, we just need to understand what the differences are and what pressures that might cause in the event of a recapture situation, or if liabilities have to go back to the home regulatory environment. That's the issue. So to be clear, we don't think Bermuda is a weak regulatory environment. We think it's a strong one. We think it's enhanced. The issue for us is to make sure we understand what the differences are between the home environment, in this case the US, and the offshore one in Bermuda. There are certainly other regulatory environments where we probably would have more concern. Bermuda's not an area for us to be particularly worried about.
Thank you, Simon. And I think I can help you here as well. I think we've mentioned in the issues paper at IAIS as well that sometimes we see that differences in regulatory frameworks are one of the drivers behind some of these transactions. So I think you're correct to say it's important to understand the differences and see how they play a role here. And I would say independently from the jurisdiction, I think counterparty default risk is one of the important risks in an asset-intensive reinsurance transaction. And so I think that points to that fact as well. We can maybe take one more question, and it's an interesting one because it's a question that I also get sometimes. Gareth, it's one for you. Do you plan or do you have any prudential limits on alternative assets?
Thank you for the question. We don't have any sort of numerical limits on alternative assets. I think a couple of things I would say on that. So we do, in common with the EU's regime, we have a prudent person principle that underlines our whole philosophy in how we think about investment adequacy. So we would expect firms and insurers to invest in assets that are appropriate for the nature of the liabilities first and foremost, and what that might look like for a long-term annuity writer where there are no surrender risks around the policies will obviously be very different to other types of firms. So we don't have any numerical limits. We have the prudent person principle that we would rely upon. I think the other thing to say is that obviously we've talked about alternative assets, but I think, as Simon mentioned, that there are many flavours of alternative assets. It can cover a whole host of things. So I think one of the useful things that the IAIS has done in its paper is to highlight some of the typical features that are associated with that around valuation, uncertainty, or so on. So I think our approach would be that we don't think it makes sense to bundle them as a group of assets necessarily compared to other aspects, but we would expect firms to think about the characteristics of all the investments they invest in, make sure they're appropriate for the liabilities, and as Emma said earlier, also make sure that they have the risk management expertise and capability to understand the risks and to manage them. Thanks.
Thank you, Gareth. I could not have summarized that any better. And I think this brings us to a perfect end to this panel. It's been short. I hope that the audience appreciated the different views around the table. I think we've had some common understanding of what the risks are, and we've seen how supervisors may react to that. For instance, we've seen also how insurers may approach certain of these challenges. I'm going to stop here. I hope you enjoyed the panel, and it's my task to give back the floor to Jonathan to prepare everyone for the next panel of today. Thank you for joining us, and see you next time.
So thank you very much, Dieter, and to all the panelists, Alison, Simon, Gareth, for this insightful discussion. And as Dieter mentioned, at the IAIS, we'll certainly continue monitoring and assessing these trends, addressing the build-up of potential risks in the global insurance sector. And just to say that the outcomes of our 2025 global monitoring exercise will be published in our annual Global Insurance Market Report, which is due out in December. Welcome back to the second and final panel for today. And this panel will dive deeper into the important issue of addressing natural catastrophe or NatCat protection gaps, as I said earlier, a priority area of our work. And the IAIS has put considerable effort into escalating this issue in the global policy space. For example, through our 2023 Call to Action report, which highlighted that all supervisors have, either explicitly or implicitly, a basis for action to address these gaps, regardless of their specific mandate. And then, together with the OECD, we also contributed in 2024 to the G7 high-level framework for public-private insurance programs against natural hazards. And most recently, the IAIS has developed an input paper together with the World Bank for the G20 Sustainable Finance Working Group under the G20 presidency of South Africa. And this paper focuses on multi-party solutions to addressing NatCat insurance protection gaps and provides possible actions that can be taken by various stakeholders to address these gaps. The paper underscores the critical role of insurance in not only managing the physical risk and financial impacts of NatCat events, but also in supporting recovery efforts and promoting resilience, most importantly. And I think our work reflects the growing importance of this topic on the global policy agenda and our commitment to provide leadership on this issue. Lastly, to mention that we also look forward to an event on this topic in the sidelines of the G20 finance ministers and central bank governors meeting in South Africa, which will take place next week, where we will have an array of accomplished speakers and panelists, including Governor Andrew Bailey in his new capacity as chair of the FSB, and senior representative from the World Bank and Ministries of Finance. In the event that you are not going to be in the meeting itself, the event will be live streamed for those that are interested in tuning in, with the link available on the G20 website. With that, I now very much look forward to hearing from the distinguished panel, and I hand the floor to Petra Hilkema, IAIS Vice Chair and Chair of IOPA, to take you through this. Over to you, Petra.
Yes, thank you, Jonathan. And hi, everyone. Good morning, good afternoon, good evening. Thank you for joining. Indeed, very important topic and relevant at every table at the globe, I would say. And therefore, I think even more important that we discuss it also today. I really have the honor to do that with a wonderful panel. And I'll briefly introduce them to you. First of all, I'm really pleased that we have the Honorable Minister Truran on our panel. He's the Minister of Finance, Economic Affairs and Investment in Barbados, and he's also co-chairing the Global Shield Against Climate Risk. So welcome to him. Moreover, we have Hendrickx, who is the Acting Global Director of Finance in the Finance Competitiveness and Investment Global Practice of the World Bank. We have Jerome Hegeli, who is the Group Chief Economist and Head of Swiss Re Institute at Swiss Re. So welcome to you. And finally, but definitely not least, Kamal Kishore, Special Representative of the United Nations Secretary General for Disaster Risk Reduction. And it's really an honor to moderate a discussion with the four of you, because these 55 minutes we're going to talk about, I think, a key topic at the international level on how to protect individual cities, communities, societies to the impact that we see from weather events and other natural catastrophes. And it's a pleasure for me to do that with you. Now, Jonathan already referred to it. The IAIS worked on a paper for the G20, and we did not do that alone. We had the pleasure of doing that together with the World Bank. And so the first part of this panel will be a short outline of what was in the report, or what is in the report, by Hendrickx. So I'll give him the floor first. After that, we'll have a round of discussion on what is the problem, what is the impact, what are the challenges, and then we will come back to the question, how can we deal with it? What are solutions? But let's first hear from Hendrickx and understand better what is in the report that was already, I think, announced, but is now out and will also be discussed next week. Floor is yours, Hendrickx.
Thank you, Petra and Jonathan, and thanks for having us on the panel today. It's a real great opportunity and a privilege to be with my esteemed colleagues on the panel on this really important topic. Also to say that we were very happy to partner with the IAIS to produce the G20 paper that Jonathan and Petra have just referred to. I won't try to summarize the entire paper, but I hope that through the discussion, we will be able to bring out some of the messages that are there, and we also hope to bring it out in the public domain soon. But let me start and give an overview. I think clearly we have seen firsthand the devastating impact of NatCats on economies and communities. We also see the promise of insurance, but that hasn't been fully met, especially for the most vulnerable. If you see non-life premium to GDP in low-income countries, it's a level which is 1/4 that which we see in high-income countries. So there's a big gap. And to compound the issue, rising NatCat risks are also increasing in insurance costs, making insurance less affordable and thereby widening protection gaps. As such, access to appropriate and affordable insurance remains inadequate in many emerging economies, leaving billions without access to adequate financial protection. So what does the report kind of touch upon? I will focus on three broad messages and one on more solutions. I think firstly, we recognize that while insurance is a critical tool and it is underutilized, by itself, it cannot solve the NatCat insurance protection gap. And what we need also is investments in adaptation and resilience and risk reduction. And these are key to ensuring and addressing the insurability question. As such, broader risk reduction efforts, such as disaster-resistant building codes, enhanced infrastructure resilience, are equally critical to reducing vulnerabilities and expanding the insurability of unprotected assets. And this is often not as much a focus as it ought to be. So that was my first message, and integrating these with disaster risk financing strategies, including risk transfer mechanisms such as insurance, creates a more comprehensive approach to disaster risk management and financing. My second message from the paper is that while we outline a range of approaches that stakeholders can consider, it is, of course, important to consider that there is no one-size-fits-all solution. What works in India may not work in Brazil. What works in Kenya may not work in Indonesia. And we need to figure out how to adapt to local circumstances and contexts, fiscal capacity, cultural context, etc., and keep the message that what works in one country may not work in another. And lastly, on the big picture messages, I think countries need to understand the trade-offs between the different options that exist, including the role of public sector versus private market solutions, and considering possible unintended consequences like moral hazard. So this becomes a really important, again, not to blindly adopt solutions, but to adapt them and consider the trade-offs which exist, including fiscal trade-offs. Many of the solutions described in the paper require significant upfront investment by various stakeholders, including the government, and these investments should be weighed against the alternative of inaction, fiscal implications, and of course, other socio-economic and political factors. And my last message, more on the solution side, and I hope we can expand on this, is that implementing successful insurance-based solutions that address protection gaps will require certain key foundation steps. I won't delve into them, but building capacity to assess exposure to NatCat events and protection gaps, including addressing data and model challenges, is crucial. The supervisory and regulatory frameworks and risk-based regulation and supervision becomes extremely critical. The issue of financial literacy and awareness of risk, and finally, incentivizing risk reduction. So let me pause here, Petra, and I'll be happy to expand on it through the discussion. Back to you.
Thank you. Thank you for, I think, very comprehensive. There is a need, but how do we look at solutions? I'll get back to what you said, but I think you gave a very clear summary of at least what the focus is of the report. Thank you for that. Before we go and continue to discuss solutions, let's go back to the problem. Let's ask, what are the key drivers and causes of NatCat protection gaps in your region? You said it, no one size fits all. I can fully concur with that. Even within an EU, there are different needs in different member states, and that is the same worldwide. So I think we have a very large international audience, and I would like them to get involved. So here's a Slido that we want to show to you, asking you what you think, what are the key drivers and causes. And I'm going to ask the panelists, but then I'll come back to the Slido and hear from you what you think it is. But let me start first with the reinsurers who see a lot. Jerome, zooming out, what are the main figures illustrating the stakes behind the protection gap? Can you say something on that? How do you see these gaps evolving in the short and medium term? And also looking broader, globally, but definitely at the EMEAs, what can you share?
Yeah, thank you very much, Petra. I'm very happy to do so. So first of all, I think let's keep, if you look at the facts and look at our data, our Sigma data, first of all, the global natural catastrophe resilience actually is rising. So on a global scale, you have more protection available for against natural catastrophes. And if you look at our data, the global protection available actually increased about 10 percentage points in 2023, which is really a global data, and it's actually more than actually the protection needed by a few percentage points, almost 5 percentage points. So that's the good news, and it's a good news because actually, if you think about the assets that you need to protect, more and more expensive assets need to be protected. Climate change, urbanization, asset accumulation, all factors are contributing to the both frequency and severity of natural catastrophes, but it's absolutely the urbanization as asset accumulation, which is actually causing the rise in the natural catastrophes cost increases, which we do see Petra, which we do see continuing at the trend growth of about 5 to 7%. So no change in terms of the trend growth. And if you then add on climate change and the likely increase in frequency, then the problem accumulates over time. But the first point was global natural catastrophes resilience is actually rising, which is, I think, is good news. However, if you dig deeper, and it was mentioned already by you, Nirai, and the report by the World Bank, definitely there are divergences with advanced economies making progress and emerging markets continuing to lag behind. So no change from that perspective if you look at the data. Third point is if you zoom out again and if you look at Nat Cat protection gap, unfortunately, while progress is being made in protection being available, is the overlapping. There's still a majority of protection gaps which are not covered. That remains to be the case. Actually, about 3/4 of global exposures are not protected by insurers. And if you look at the difference between advanced economies and emerging markets, it's really mind-boggling. If you look at the differences, about 94% of emerging markets natural disasters is not covered. So more than 90%, and that ratio is about 60% for advanced markets. So big differences. I think looking ahead, and we talked a little bit about the solutions. I won't go into too much detail, but let me just mention maybe 2 or 3 points, Petra, if you allow me. So number one, I think narrowing the protection gap, it requires all efforts, but it requires also structurally to lower the loss potential, while also being mindful, obviously, that you need to have the protection available, the increasing insurance, but there definitely is no one size fits all. But structurally lowering the loss potential, I think that is definitely something which also needs to be front and center. And with that, I just wanted to also emphasize, yes, the need and priority that should be given to avoid and reduce the losses. Because if you think about that, and that's my last point, if you look at the data and if you actually recognize that it's not climate change, but actually climate change is a contributing factor, but actually it's urbanization, asset accumulation, which is the root cause of the natural catastrophe increases and also protection gaps. It's really important that with time passing and climate change seemingly not improving, that we need to put more priority into avoiding and reducing the losses, while also investing and supporting at the same time, investing into risk prevention, but also supporting all efforts in mitigating the risk in the first place. So let me leave it at this, and happy to come back later on. Thank you, Petra.
Yeah, thanks, Jerome. And I think that's a nice bridge to Kamal, because Kamal, I mean, you work for the UN for disaster risk reduction, so reduction of the risk. I can imagine that you see a lot of these risks and the impact of these risks, economic impact, societal impact around the globe. Can you say a bit more on what is the impact of what we're seeing currently?
Thank you. Thank you very much, Petra. Before I respond to your question, I just want to share one good news. The good news is that decade on decade, mortality related to disasters is going down, and it's going down very significantly, 50% in some parts of the world, up to 94, 95%. Of course, we cannot declare victory there either, because that progress needs to be consolidated. You know, there are vulnerabilities, there are risks lurking in the global system of low frequency, high impact events, which could easily dampen this progress. So, but when it comes to the direct cause of disasters, it is increasing really exponentially. If we look at the first 2 decades of this century, the average loss annual is up to $200 billion. The same figure for the preceding decades was a third of that, price adjusted. So it's really escalating very rapidly, and it is not just the numbers in terms of dollar figures aggregated, but also number of people that are affected. Number of people that are getting affected is also rising very rapidly. People who are losing their homes, those who are losing their livelihoods. And if you add to these direct costs of what I said, $200 billion, the indirect costs, the productivity losses, the losses to ecosystem services, I think it all adds up to something like $2.3 trillion every year. So we are losing a lot to disasters. This is really a big problem, particularly for smaller economies where there is a disaster impact. It leads to debt. It leads to building back worse than it was before, and it's a downward spiral. I think if we have to arrest this downward spiral for these economies, it's really important that we have robust solutions, a full spectrum approach, as Neeraj was saying and Jerome was saying earlier, that we have to look at insurance, but also we have to look at what are the measures we're going to implement to reduce the loss potential. There is no option but to reduce the loss potential. By 2030, for example, it is estimated that 500,000 houses in Australia will become uninsurable because risk is just so high. We are not building in the right place. We are not building in the right manner. And this is an advanced economy with pretty robust disaster risk governance systems. So it's really important that the way we structure insurance programs, they should really encourage investment in risk reduction. For example, if you're living in an earthquake-prone area and you are insuring your house, and next year you invest $10,000 in retrofitting that house, then your premium must come down. Otherwise, you're not creating incentives for investment in risk reduction. And another point, which is again a repetition of what Neeraj said earlier, that it's not one size fits all. We really need homegrown solutions for insurance which work in different contexts. There are examples in emerging markets where subnational entities have taken insurance, parametric insurance, and an event has occurred. It has just stayed below the threshold. So there is damage everywhere, but there is no payout because the threshold hasn't been met. I think it's really, really challenging because, in many emerging markets, the building standards are very uneven. There are many dozens of building types. It's very difficult to predict how, at the population scale, buildings will behave. And parametric insurance in those cases runs into some sort of a trouble. This is not a case that we should not pursue parametric insurance, but what I'm saying is that it really has to be set in the context where you're developing it. It really has to be rooted in the local context. In that space, I think what the insurance supervisors can do is a lot. They can really work towards developing fit-for-purpose solutions for such contexts. And looking forward to further conversation on this very important issue.
Yeah, thank you, Kamal. A call for solutions, for looking indeed in what we hear. Although I'm really happy to hear about what you started with by this reduction in loss of life. But I think even if life is not lost, many other damages can happen, and we just heard the numbers. So let me now go to Ryan Strawn and ask, as a co-chair of the Global Shield Against Climate Risks, can you share some examples of how you work and how your work provides and facilitates better pre-arranged protection against climate and disaster risk? So indeed, to what are fit-for-purpose solutions and what have you seen work in practice? And I need you to unmute yourself, Minister.
Thank you very much, Peter. Yes, thank you. So happy to be here to join in the discussion this morning. The work that we've been doing with the Global Shield, and as Barbados also shares the Climate Vulnerable Forum, the V20, we have been working with countries across the world to be able to identify the solutions clearly that would work for them. Now, we have put in place a mechanism, for example, to have prearranged financing with respect to multilateral banks, World Bank, IDB, at least in our region, and similar entities across the different regions, in order to provide immediate liquidity in the post-disaster environment. Under the Bridgestone Initiative, as you know, Barbados has been championing very strongly the need for the inclusion of natural disaster clauses, climate resilient debt clauses, to be able to give countries, again, additional resources should the worst happen. But let me also say that we have been pushing countries to also develop their climate investment plans, which will speak to the investments required to deal with mitigation as well as adaptation. As a very clear sense to be able to mobilize not just what the public sector has to do, but equally what private sector investment is required in order to build resilience upfront, because we've all been clear. We do not want to experience a disaster to get debt relief or even to access these resources. The preference is to build resilience upfront such that when the disaster happens, there's as minimal disruption as possible. But let me just point out that clearly in Barbados here and in the Caribbean, and to the extent that the panelists have identified some of the challenges already, we are seeing not just the increasing frequency, but also the intensity. The damage that is being caused throughout the Caribbean region, which then leads into Florida, leads into Texas, and you're seeing the withdrawing of insurance solutions from those spaces. So to the point that was just made about persons investing in the Caribbean and being able to do the necessary retrofitting to make their homes and structures more resilient, the reality is that you're still operating in a risk pool. And if there are millions of properties being withdrawn from the insurance risk pool, even though we are trying to build the resilience within the Caribbean, the harsh reality is that within the context of the reinsurance market, less properties sharing the risk means then that ultimately there is still insurance premium, if you like, that still has to be covered. And therefore, that's something that we need to put our heads together to figure out how do we solve that issue, because we want to be able to mobilize domestic resources to put more into building resilience. And therefore, I think we need to be able to come up with creative solutions to be able to close that gap. Now, we have been, in the context of Barbados, we have been developing with the Insurance Development Forum, a public asset investment program, insurance program, sorry. Because as we've built infrastructure in the past, we've never really particularly looked at the type of insurance that even government covers for its assets versus what is happening across the rest of the country. So in addition to that program, we have had some work done with the Inter-American Development Bank. We've developed a national coastal risk integrated platform, which identifies each risk to each structure across the island. And that tool is really going to allow us to be able to identify the type of mitigation and adaptation measures that will be required in order to address those issues long term. And therefore, when we say that we want to focus on building resilience, it is utilizing the data in terms of what we have to be able to develop those solutions. And we hope that we will be able to mobilize international resources to help scale and help us to be able to achieve this. And let me just end on this last point very quickly. As small states, I'm absolutely confident that we can find the financial engineering to bring to bear to these problems. Our challenge is not just with financing, but is also accessing the technologies that allow us to be able to build the resilience quickly. And therefore, as small states not requiring a lot within the context of a global environment, procurement or the size of our procurement is perhaps too small to attract the attention of the producers. But that is what is going to help us really drive the resilience building effort. And therefore, as we are able to focus more on how insurance can help, can be part of the solution for building resilience, I think we also need to focus on the fact that unless we have a dedicated access to the technologies in a specified time frame, that going to be able to build the resilience as quickly as possible. But I think under the Global Shield and what we're doing with the B20, we're pushing countries to be able to, in advance of any disaster, put those arrangements in place, but equally start to build resilience immediately in order to minimize the impact of the disaster. I'll end there.
Thank you, Minister. Thank you very much. And it's also this combination, and I think it was very, very well said already by our first speaker, when he said disaster risk financing, that is resilience, and maybe if something happens to recover, but much more important, the resilience in combination with that adaptation. Both are very important. Definitely the resilience part, but resilience also needs financing and can meet a global scale. Thank you for that. Let's look at the Slido. Let's go back at the Slido and see what the audience said. Well, what are the key drivers? I think the first observation, I think we all can see that, is that many say it's the rising frequency and severity of the events resulting in increasing damages. It's a reality. I think that's the reality check, what we have to deal with. But then I think also below there we see the lack of risk awareness, financial literacy to get the products, understanding of the products, maybe also the trust in the products. So here already, this is relevant for insurance, affordability of the products, and ultimately also regulatory barriers. So thanks for that input. By the way, if you want to ask a question to this wonderful panel at the end of the session, do share your questions in the chat. But let's go back to the panelists and let's now talk about those solutions and hear from you what you would think. Niraj clearly said that there's three things. The one I mentioned already, the resilience and the adaptation, but also there's no size that fits all, and all the speakers touched on that. And there is also a trade-off between the solutions you do and unintended consequences like moral hazard. And I'm first going to go back to Jerome and ask you, Jerome, representing on this panel the insurance, particularly reinsurance industry, what can you do to help deal with this risk?
Well, thanks a lot, Petra. What can we do to help the risk as a insurance or reinsurance industry in particular? Well, first of all, what is the role that the reinsurance industry plays in terms of mitigating and reducing the nat cat risk? And it's multidimensional. First of all, we put with the insurance premiums, and it's important that the insurance premiums are commensurate with the risk of the underlying insurance, because the insurance premium, they serve as signals of pricing the risk. So number one, we price the risk and we give the risk price. Number two, we transform the risk. So we obviously provide risk protection, underwrite the risk. With the underwriting the risk, you also can take on more the risk. So that's the risk protection. And number three, it's also a very important role that the insurance and reinsurance industry plays. We invest. We invest in the assets. We also serve as a long-term investors. I think it's really important that we keep this multidimensionality into mind in thinking about what is the role that the insurance or reinsurance industry plays. Now, coming to the solutions, what is the solution? What will be needed in terms of reducing and narrowing protection gaps? In order to narrow protection gaps, it's important that we have the good data, that we have modeling, which is state of the art. Obviously, there's many other parts needed as well. But let me just talk about the data modeling technology and technology on top of that, and give you one example to illustrate why I chose data and modeling. Flood, and also close to Basel, close to Europe, floods is important risk driver for natural catastrophes. And floods, as you know, it was once viewed as uninsurable risk because you couldn't price it, because you didn't have a history on it, and because it's very local. However, there has been a lot of improvement on the tech front, a lot of improvement in terms of the modeling front, and now you have fully probabilistic flood models which allow the private insurance industry also to put a price tag on the risk. So data modeling is definitely very important for the future in order to provide the risk protection. Other than that, I think it's coming back to the other topics that was raised already, so I won't go into much detail. But as losses continue to grow, the priority must be given to avoid the losses and reduce the risk in the first place. And I just wanted to highlight again, Glenn, the benefit of adaptation efforts. If you look, and as an economist, it's a no-brainer. I think every $1 you spend on adaptation, it yields about $10 in benefits, according to the research that you look at. If you look at Swiss Re research and IMF research, it's close to 1 to 10. So structurally lowering loss potential brings down the cost of insurance coverage. With higher economic inflation, you have higher insurance prices as well. Adaptation, it will reduce loss potential, and it also allows affordability, allows the mitigation and the headwinds that you have in terms of insurance affordability. But maybe to close, Petra, and the key point, what we definitely need is that transparent and risk-based pricing system with a capital requirement which is commensurate to the system, and on top of that, allow also innovation to play its role in order to allow the protection gaps that we are seeing, which are increasing, which is a very definitely that these protection gaps also actually narrow. So it's multidimensional role that insurance play, but you also need the multidimensional solutions in order to narrow protection gaps. Thank you.
Yeah, thank you, Jerome. And I fully agree. It's not one actor in this ecosystem that can make the difference. It's a joint effort of coordinated action that we need, including, by the way, the supervisors. And with that, I just refer to the Slido question that is on the screen, where we actually ask you what you think we as supervisors could do. And I look forward to your answers. We'll get back to that at the end of this round, because I'm going to ask the 3 other panelists as well on solutions. What can we do going forward? Maybe where will be the challenges? And I'll go back to Ryan Strawn and ask you, how can we ensure that financing mechanisms to combat losses for climate-related events are accessible and are equitable? And I do think you alluded to it already a bit, and also the challenges there, but would you like to say a bit more on that?
Yes, thanks again, Petra. Just 2 weeks ago, I spoke to our Caribbean Association of Insurance Regulators on this very critical topic, because on average, every year across the region, we have about $750 million or so in premiums. But on average, in any given year, there are only claims of roughly, on average, 250 million. Okay? Now, clearly, those resources are leaving the region, and therefore the focus on how do we recalibrate to ensure that we maintain, yes, an insurance relationship, but we use existing resources to actually help build the resilience and adaptation that we know that we need to do in order to ensure that the disruptions to people's lives, and certainly people dying, will be significantly reduced. And I think, as we've just seen, certainly with the Texas floods, that it is important to appreciate that while your built infrastructure needs to be maintained, not just put in place, but maintained to ensure that you can minimize the disruption. So I feel that within the context of the Caribbean, and working with regional governments and regional regulators, we have to devise solutions to genuinely mobilize some of the existing financial resources and deploy that aggressively in the context of countries having developed their climate investment plans, to be able to say these are the priority areas that we will implement over the course of a few years. That helps us to be able to ensure then that the very businesses and the investments that people are making remain insurable and investable, because at the end of the day, as small states, as my prime minister would say, if something isn't insurable, it's not investable. And therefore, even in the context of getting your economies to remain attractive, and I use the word attractive only from the perspective of both domestic investment as well as foreign investment, that the insurance bit has to be resolved. And I feel that that's a mechanism that we can put in place to in a sense, incentivize the adaptation and resilience. So the truth is, in our region, people have, and I think it was Kamal that raised the issue. People pay the premiums. An event happens, and it happened with Hurricane Elsa actually when they passed 3 years ago, and it doesn't meet the threshold for people to get a fill from insurance. And I think we need to ensure that as we look at the problem in full, that the people who are actually paying insurance premiums year in, year out, that when something happens, there must be a mechanism that allows them to access the help that they need if we are going to maintain the public trust in the insurance sector. So I think, as I said earlier, I fundamentally believe that we can find the financial engineering to make this work because we are sufficiently small that it can be done. But unless we get that in tandem with the access to the technologies to deploy quickly, then I think we may struggle. But I believe that this is something that in the context of the Caribbean, we got with the other governments to be looking at to see how we can, in a sense, create something akin to a Caribbean captive to deploy some of those resources to actually build the resilience at the regional level. And I think that that's something that we will be pursuing in the coming months and a year or two to make sure that in the context of the region, that the financing for building resilience can come in part from some of the domestic resources whilst we mobilize at the international level as well. Thank you.
Thank you very much. And what I hear is that I hear a lot about possibility. I hear possibility. I hear resilience. But the need to finance that somehow, and at the same time, I also hear the need for the ask for if you pay your insurance premium, is that just for those cases where you need the payout, or is there a way to also use those funds to build the resilience so you actually have less damages, which is I think the thinking we need to go towards to. How do we use the finances? Now I think others who step in after disaster are often public authorities. They say they reach out to the public saying we will come and help. That involves also real money, and can that money be better spent ex ante to build resilience? And here I of course am alluding to public-private partnerships to address the protection gap. And Neeraj, can I come to you and ask you, are there examples of public-private partnerships that you can share that you would identify as good examples?
Thank you, Petra. And I think clearly public-private partnerships have emerged as a key strategy for closing the protection gap. I think Jonathan mentioned G7 high-level framework against natural hazards, which is gaining traction. So for us, I think if they are well designed and implemented, public-private insurance programs, or PPIPs, as we've been calling them, can be an important part of the solution to address NatCat protection gaps. But we have also seen misuse and inadequate outcomes, premium subsidy skimming, incentivizing, for instance, growing wrong crops that don't fit the agroclimatic conditions. So it needs to be done right. But if it is done right, it can be very powerful. And I'll come to a couple of examples. But before that, just to flag that these are most effective when they involve multi-stakeholder collaboration. As for these partnerships, we really need to leverage both the strengths of the public sector and the private sector. For instance, supervisors can provide the regulatory and supervisory oversight. And there was a question in Slido on that point. They can play a critical role on this one. Governments, international organizations, and multilateral banks such as us can provide financial and technical support and secure access to data and information, support market infrastructure. Private insurance obviously can bring their expertise in underwriting, risk assessment, and claims management, as we heard earlier. Now, PPIPs can take several forms, ranging from provision and sharing of data to joint efforts on preventive measures and cat risk insurance programs, involving risk sharing amongst private insurers and governments. So there are two examples I'd like to quickly cite. I think one is from Turkey, where the Turkish catastrophic insurance pool, or TCIP, was established to increase protection against NatCats such as earthquakes. The government plays a critical role there. So again, on the point of multi-stakeholders, in providing a financial guarantee and building the conditions for insurers to thrive, compete, and collaborate. Private insurers use their capital, expertise, and systems to provide insurance, sharing risk together to increase their ability to protect households and businesses. The pool now insures more than 50% of the population and demonstrated its efficiency after much needed payouts after the very terrible earthquake in 2023. Similarly, in Morocco, the World Bank helped develop a dual program that built on market-based insurance and solidarity principles to protect both insured and uninsured households against disasters. And it covered insured households by extending protection in all property insurance policies to include NatCat risk, while protecting uninsured households through a solidarity fund. And following again the earthquake, the Al Haus earthquake in 2023, the fund paid out roughly 300 million, out of which 275 came from international reinsurance markets. Again, illustrating the link between public and private and financial markets on this point. So let me pause there, but these are two great examples from our countries.
Thank you, Niraj. And just speaking a bit from my part of the world, what we also saw is in the flooding of Valencia that there is a public-private partnership. And here, not only the financing was organized, but actually reaching out to the public was done by following the insurance channel. So it was back from the central level through the brokers to the consumers to make sure that they would be compensated for their losses as soon as possible. Then I'll go to Kamal and also ask you in this context, particularly I would like positive examples, but have you seen positive examples that could inspire us thinking about how to address these issues to take home?
Thank you. Thank you very much for that, Petra. First of all, let me say that the input paper that IAIS and the World Bank have prepared, particularly the aspect of incentivizing risk reduction through the right kind of design of insurance instruments, is really something which resonates with us. About 6 weeks ago, we launched a global assessment report on disaster risk reduction. It has several case studies of where it has worked really well. For example, in Colombia, insurance for earthquakes to poor households, but structured properly, has increased adherence to building codes and communities themselves building safer houses in the first place, because that's, insurance is linked to a certain minimum level of earthquake safety. So it can really work like that. We also have a partnership with the Insurance Development Forum, where we are working in Argentina and working with municipalities there to see how the premiums would work out with or without risk reduction measures. So I think when we bring both of these things together, I think we can create solutions which are more sustainable, more workable. We have a partnership with the UN Capital Development Fund, working in some Pacific Island countries, on looking at how we can actually spur the local insurance industry, how we can come up with bundled insurance which looks at catastrophic risk but also everyday risk, so that people actually begin to see benefits of buying insurance relatively soon. So I think some imagination is required there as well. My final pitch is that, earlier today, Jerome talked about probabilistic risk assessments. I think it would be great if probabilistic risk assessments or risk matrix became more widely available, produced at multiple levels, national level, subnational level, sometimes even local level, so that people begin to understand in a bit more intuitive way what risk is when you begin to quantify it, and what is the role of risk reduction and risk transfer in addressing this. For very long, this whole area has been very specialized and largely stayed with the insurance industry. It's now time to democratize some of this risk analytics. Thank you.
Thank you, Kamal. And again, also here on the assessment of risk, how do you identify them? How can you do that more together? What I do now is actually I want to refer to some of the questions that are asked, and I thank you for those who asked the question. And I'm first going to stay with statistics, but maybe slightly on and with you, Kamal, but maybe not per se on this, but going back to your first comment that has triggered some interest, but also from Jan Bauer, who's asking the question. He's from the US supervisors, the NAIC, and he's asking, could you please share additional details about the statistic that mortality from NatCat events has fallen about 50%? And could you maybe be more specific on particular types of NatCat events? So does it include hurricanes, tsunamis, earthquakes? Could you say something more on that? You need to unmute yourself, sorry, and start again.
So if you use 2005 to 2015 as the baseline period and look at the subsequent years, 2015 to 2025 as the measurement year, in most parts of the world, mortality is down by 50%. And this includes principal hydrometeorological hazards such as floods, such as cyclones, such as coastal, all different kinds of floods, cyclones, droughts, although droughts have never had many direct mortality in any case, but also principal geophysical hazards such as earthquakes and tsunamis. So I can give you a specific listing of these hazards, but mostly natural hazards, both hydrometeorological and geophysical. So in some parts of the world, for some hazards, the mortality has gone down significantly. Mortality risk has also gone down. For example, if you live in a cyclone-prone area, the chances of dying now compared to 15 years ago, global average, is a third of what it was 15 years ago. So big progress, but it comes with a few qualifiers. The first qualifier is that for some of these hazards, and here I have to underline extreme heat, it is entirely possible that we are undercounting the deaths because attribution is a very tricky problem there. So I think I would put a big circle around that. But for many other hazards, there is undeniably significant reduction in mortality.
Thank you, and I fully appreciate the part what you say about heat, and I think we underestimate possibly the impact that heat has on health and casualties. So I have one more question, and then I also close the floor because we're almost going towards the end of time. But I have a question from Dave Snyder, who is from the property and casualty insurers. And I'm looking at the panel who would like to take the question. Is there someone who can say a bit more about the role of microinsurance and parametric insurance and risk-based pricing, and how could that work in dealing with this issue?
I'm happy to do so, Petra. Microinsurance, super important. Parametric insurance, super important. Nothing new to the insurance industry. Microinsurance, especially for developing countries, it's a central pillar in providing access to insurance products, and parametric insurance, which is insurance products linked with predefined triggers. It also allows quick payment, cash payments, and triggers the insurance to be activated very quickly, which is also very positive, I think, for the households, corporates, or society at large, because you get the benefit of the insurance exactly when you need it, when disaster strikes. So yes, I think both product features, parametric insurance as well as micro insurance are features which are very very popular in the respective for respective perils, risks, or then regions of the world. Yeah, thank you for having mentioned that.
Thank you for and again and I think that's what we started with and what Neeraj also said is that any solution can also have an unintended consequence, and we did allude that parametric insurance is very efficient and quick, and I think it's how you know what risk you're covering, and at the same time, if an event just not triggers the right trigger, there's a lot of damage. I know. So there's always the pros and the cons. I think they came out today, but I think what stood out today mostly is that it takes an ecosystem to work on this. It takes not only between government and insurers and cities and individuals to mitigate, adapt, and address the issue and find financing strategies. It takes a global effort to help each other in different regions, because that is in the end also how you diversify risk and how global finance can support the parts of the world that need it. A lot of food for thought there. Thank you very much. I did not forget that this is in the end a global seminar of the insurance community, and I want to go back then and to close it off, just seeing what you gave as feedback on the question, what should supervisors do? What actions should supervisors take? And here it is. First of all, assessing the insurance protection gap. I think many of us do. Is there a gap? What is it? We can't give credible information. Advise governments, industry on the solutions. That's the number two, including public-private partnerships, which again, for me, public-private partnership is so much more than having some money ready when something has happened, but it has to be about the public and private working together to build resilience, to create awareness, and to enable people to address the risks that are there. Here it is, incentivizing the risk reduction, therefore, is a third, which I think comes very close, and then improving literacy and risk awareness and supporting the development of innovative products, finally creating and implementing a risk-based and proportionate supervisory system. Thank you for that feedback. We will take that at heart while we continue to work on it together with you. Thank you for all the feedback. Clearly, 55 minutes to address such an important topic is way too little, but I do think we got as much out of it as we can, thanks to a great panel. So I want to thank the panelists. Thank you, Neeraj. Thank you, Jerome. Thank you, Kamal. And thank you, Commissioner Strachan, for being in the panel and sharing your insights. And then with that, I'm going to give the floor back to Jonathan.
Thank you, Petra, and let me add my thanks to an excellent panel of experts and to you for this very important discussion, which certainly I think left us with food for thought as we come to the end of this year's global seminar. Also food for thought about moving into action. And I think you'll hear more from the IAIS on that in the period ahead. So with that, I'd like to extend a heartfelt thanks to all of you for participating, asking questions, engaging us over the past 3 days. This really provides significant value to our work and hopefully gives you some very good insight into what will be keeping us busy in the period ahead.